Let me show you something. Over the last few weeks, petrol prices were hiked for the first time in 4 years. The rupee touched 96 against the dollar, a record low. Wholesale inflation jumped to 8.3%, and foreign investors pulled billions out of Indian market. Now, here is the important thing. These are not separate, unrelated headlines. They are one chain reaction. And if you understand how that chain works, you will understand India's economy better than most people who argue about it on live television. That is what this video is for. Not to scare you, not to predict a collapse, but to explain what is actually happening, why is it happening, and what a sensible person should do about it. Let's go step by step. Everything in this story begins with one commodity, crude oil. India imports close to 90% of crude oil it needs. This is not a new problem. It is a structural feature of Indian economy that has existed for decades. Now, why does this matter so much? Because oil is not just a fuel for your car. It is the input cost behind almost every physical thing you buy. Trucks that carry vegetables run on diesel. Factories that make medicines use petroleum derivatives. Fertilizers that grow your food are made from natural gas. Plastics in packaging, electricity generation, flight fuel, nearly all of it traces back to crude oil. So when oil prices rise, it is not one sector that gets affected. It is everything simultaneously. Right now, the Indian basket of crude oil was at $150 per barrel in April 2016 and around $106 in May. That is the first time in over 12 years that India has crossed the $100 mark for 2 consecutive months. The cause is the ongoing West Asia conflict, which has disrupted supply chain expectations globally. Now, here is the first economic concept worth knowing: current account deficit. A country's current account is the scorecard of everything it buys from and sells to the rest of the world: export, import, and income flows like remittances. When India imports more than it exports, the difference is called the current account deficit, or CAD. Oil is India's single largest import item. When oil becomes expensive, the current account deficit widens automatically, even if nothing else changes. India has to pay more dollars to the rest of the world than it earns back. Analysts expect India's current account deficit to widen between 1.7 to 2% of GDP in the current fiscal 2026. This is driven by higher oil prices and ongoing global trade pressure. A wide current account deficit matters because it means India needs more foreign currency to fund its obligations. And when that foreign currency, primarily dollars, becomes harder to earn, the currency comes under pressure. Which brings us to the rupee. The Indian rupee is currently trading around 96 per dollar, near its record lows. It has depreciated about 11% against the dollar over the past year. Nearly half of that fall, around 4.7%, happened after the West Asia conflict escalated. Let me explain why currencies fall during the situations like this. India needs to buy oil. Oil is priced in dollars. So Indian oil companies go into the market and buys dollars. When the demand for dollar rises sharply, the dollar strengthens. And as the dollar strengthens, the rupee weakens. Now watch what this does to your import bill. Suppose oil is priced at $100 per barrel. At 80 rupees per dollar, India pays about 8,000 rupees. At 96 rupees per dollar, India pays 9,600 rupees. Same oil, same quantity, but India is paying 1,600 rupees extra per barrel purely because the currency moved. And this is what economists call imported inflation. Imported inflation is a price rise caused not by domestic demand heating up, but by weaker currency making imports more expensive. It is an inflation that arrives from outside your borders. And it is particularly difficult to control because monetary policy alone cannot fix the source of it. Here is the related concept worth understanding. Terms of trade. This simply means how much of your own goods and services must you give up to import one unit of something else. When oil is cheap and the rupee is strong, India's terms of trade are favorable. You export software and textiles and you can import lot of oil in return. When oil is expensive and the rupee is weak simultaneously, India's terms of trade deteriorate. You are now exporting the same amount but importing less for it. The country is, in aggregate, getting poorer in real terms relative to the rest of the world. That is the underlying squeeze happening right now. Not a headline, a structural shift in what India can afford. Now, let us zoom out and see how this becomes self-reinforcing. Oil rises. India needs more dollars. Dollar demand increases. Rupee falls. Import gets more expensive. Inflation rises. Foreign investors get nervous about the returns and currency losses. They pull money out of India. That selling creates even more dollar demand. Rupee falls further. This is the feedback loop that economists call currency inflation spiral. Now let us look at the foreign investors piece more carefully, because this is where two important concepts comes in. Hard money versus foreign direct investment. Not all foreign money is the same. Foreign direct investment, FDI, is a long term. A foreign company builds a factory in India, hires workers, produces goods. That money does not leave quickly. It is committed. Hard money, or the foreign portfolio investment, is short term. Foreign investors buy Indian stocks or government bonds because return looks attractive. But when the situation changes, when the rupee weakens or when interest rate in US rise, making dollar asset more attractive. And this money can leave within days. And in March 2026 alone, FPOs, foreign portfolio investors, pulled out close to $20 billion from Indian assets, the highest monthly outflow in 6 years. So this is classic hard money behavior. And it is the kind of outflow that creates negative spiral in currency and market simultaneously. The deeper concept here is capital flight. When money leaves a country rapidly because investors fear losses or currency depreciation or economic instability, capital flight accelerates the very problem that caused it in the first place, which is why it is so dangerous for emerging markets like India. Let us now talk about inflation more precisely. There are two different inflation numbers you will hear, and they measure different things at different points in the supply chain. Wholesale Price Index, WPI, measures price changes at the producer and manufacturer level, what factories and distributors pay. Consumer Price Index, CPI, measures price changes for actual household, the prices you pay at the shop for rent, transport and services. So India's WPI, wholesale price inflation for April 2006, came in at 8.3%, driven primarily by mineral oil, crude petroleum and natural gas and basic metals. India's CPI for April 2026 rose to 3.48%, the highest in 1 year, though still well below expectations of 3.8 to 4%. Notice the gap. WPI is at 8.3, CPI at 3.48. That gap exists because the businesses absorb the cost increases before passing them to consumer. They reduce margins, they optimize logistics, they delay price hikes. But they can only do this for limited time. And this brings us to an important concept: inflation pass-through. Pass-through is the process by which producer-level cost increases eventually travel down to the supply chain and appears in consumer price. The pass-through is rarely immediate. It typically has 2 to 4 months lag. This means the current WPI reading is a leading indicator. It is telling you where the consumer prices are likely to go later this year, not where they are today. Now here is the another distinction that explains why inflation feels worse than numbers suggest. There are two fundamental types of inflation. Cost push inflation. When the prices rise because production cost increase, oil become expensive is a cost push. Manufacturer did not choose to raise the price. Their costs were forced up from outside. Then the demand pull inflation. When the price rise because too many people are chasing too few goods. This typically happens when economy is overheating, when the incomes are rising rapidly and everyone is spending. India right now is experiencing cost push inflation. That is actually important to understand because the policy tools designed to fight demand pull inflation, raising interest rates, reducing money supply, that do not clearly fix the cost push inflation. You cannot raise interest rate to make the West Asia conflict end. You cannot tighten monetary policy to reduce global trade crude prices. This is what makes the current situation structurally awkward. This situation puts RBI in genuinely difficult position. Here is the context. Early in 2025, when the CPI inflation had fallen to around 2%, the RBI cut interest rates multiple times to support the growth. Lower rates encourage borrowing and spending and investment. But now, with oil prices rising and the rupee under pressure, inflation is moving back up. The RBI cuts rate further to support the growth, it risks adding fuel to inflation and weaken the rupee more. And if the RBI raises rates to defend the rupee and curb inflation, EMIs go up and growth slows and business suffer. And this is called growth inflation trade-off. And every central bank fears it because there are no clear solutions. Analysts at the MK Global have noted that a rate hike looks increasingly inevitable, but they also cautioned that it would be an imperfect defense. Equity outflows could overwhelm debt inflows, and markets could interpret a rate hike as a sign of policy panic rather than confidence. So here is a concept that explains why this is so uncomfortable. Real interest rate. The real interest rate is simply the nominal interest rate minus inflation. If the RBI keeps the repo rate at say 6%, but inflation is running at 4 or 5%, the real rate is only 1 or 2%. That is quite low, and it means money is cheap in real terms, which can feed further inflation. But if the RBI raises rates aggressively to push real interest rates higher, borrowing slows, consumption falls, and the businesses that took loans to lower rates suddenly face high EMIs. The RBI is not asleep, but it is navigating a situation where the root cause, a geopolitical conflict driving oil price, is completely outside the reach of Indian monetary policy. Now the context that most discussions skip. India is not in crisis, and the key reason is its foreign exchange reserves. India forex reserves are at $700 billion as of last week ending May 8, 2026, covering around 11 months of import. Generally considered a very comfortable buffer. So two concepts to understand here. Import cover ratio. This tells you how many months of imports a country can fund purely from its forex reserves, without receiving any new dollars from exports or investment. 11 months of import cover is considered very strong. Economists typically worry when it falls below 3 months. In 1991, India had import cover of barely 2 to 3 weeks and had to pledge gold with foreign banks to raise emergency cash. That was a genuine crisis, and today's situation is structurally different. Second concept is the balance of payments. This is the complete accounting of all money flowing in and out of country. It includes current account, trade and remittances, a capital account, investments flowing in and out, and changes in forex reserve. When more money flows out than in, reserves fall. India reserves declined from peak of $728 billion from February 2026 to around $697 billion in early May, as the RBI sold dollars in market to slow the rupee fall. The forex reserve is India's economic shock absorber. not to fix the rupee at an artificial level, but to slow the pace of its fall and prevent disorderly, panic-driven move. The concern is not that India will run out of reserves. The concern is that a prolonged external shock makes that buffer steadily smaller before the situation resolves. So here is the part that does not get discussed in. Economic shocks are not neutral. They affect different groups differently. Wealthy households, they own assets, real estate, gold and stocks. During inflation, asset value often rise, partially offsetting higher living costs. Low-income households often receive direct government support, subsidized food through PDS, LPG subsidies, fuel support in states. The middle class is caught in the middle, in the most literal sense. So most middle class households earns primarily in salaries. So salaries typically rise 8 to 12% in good years. But during elevated inflation, when groceries, transport, school fees and EMIs rise simultaneously, your purchasing power can shrink even when your salary number goes up. This is called real income decline. Here is a distinction you need to hold clearly in your mind. Nominal income is the number on your salary slip. It goes up by 5-10% and you feel richer. Real income is what that salary can actually buy. Your nominal income adjusted for inflation. So if prices rises by 12%, while your salary is rises by 10%, your real income is actually declined by 2%. You are nominally richer, but actually poorer. There is also a related concept that rarely gets named but affects everyone: inflation tax. This is not a tax anyone votes on. No parliament passes it. But when the inflation rises, the purchasing power of every rupee you hold quietly erodes. Your savings in bank account earning 3% interest in a 5% inflation environment, and they are losing 2% of real value every year, silent and automatic. Government can sometimes benefit from inflation tax because it reduces the real value of outstanding debt. But for savers and salary earners, it is also a pure cost with no offsetting benefit. This is why many middle class families feel that despite earning better than their parents, they are somehow unable to save as much and feel as financially insecure. That feeling is economically accurate. It is not imagined. Now the part most channels skip. What does a sensible person do in this kind of environment? Let us start with the core concept that should anchor all your decisions right now. Real return on investment. Your saving and investment should not just grow in nominal terms, they should grow faster than inflation. If your fixed deposit gives 6.5% and inflation is running at 5%, your real return is only 1.5%. That is not a wealth creation, that is barely preserving value. Every financial decision you make should be measured against this benchmark. So with that in mind, 1. Separate essentials from discretionary spending. In an inflationary period, some expenses will rise whether you like it or not. Fuel, groceries, EMIs. These are not optional. But subscription services, lifestyle upgrades and non-essential purchases are where you have genuine room for savings. 2. Review where your savings are sitting. Money in regular savings account earning 3-4% interest is losing real value when inflation is rising. Fixed deposits at 7% or liquid and short duration debt mutual funds with comparable yields. At minimum, keep your closer to even on real return basis. 3. Do not pass your SIPs. If you are invested in equity mutual funds through SIPs, this is not the time to stop. Markets fall during economic stress. That is expected and normal. But historically, equally, as an asset class is one of the very few instruments that genuinely outpaces inflation over 5 to 10 year horizons. Passing your SIP during downturn means you miss buying at low prices, which is when the long-term return gets built. 4. Avoid stretching into new high-interest debt. If interest rate rises, as analysts expect, floating rate loans become more expensive. EMI on existing variable rate home loans may also increase. This is not the time to make large leveraged debt. 5. Factor the rupee into a dollar denominated plans. Foreign education, international travel, imported electronics, all of this cost significantly more at 96 rupees to the dollar when you buy at 80 or 82 rupees 2 years ago. Plan and budget accordingly. So, none of this is a dramatic advice, but that is the point. Sound financial behavior during uncertainty is almost always boring. It is about not panicking, not making large, irreversible decisions, and ensuring your existing financial structure is resistant to the pressure around it. So let us all put this together. India is dealing with real external shock. A high oil prices from geopolitical conflict, a weaker rupee, rising wholesale inflation, and cautious foreign investors. So these are serious pressures, but India has significant buffers, a large forex reserve, a functioning central bank, and economy that's still growing. So the right response to understanding this is not an anxiety, it is literacy. When you know what WPI rising today is a leading signal for CPI later, you can plan ahead. When you understand why the rupee falls, you stop being surprised by rising prices. When you know what import cover and real interest rate mean, you can separate genuine risk from media noise. This is exactly what this channel is trying to do. If this kind of analysis is useful to you, kindly subscribe. I will see you in the next video. Thank you.